Why AMC stock may be on the verge of another short squeeze. Elevated short interest, sky-high borrowing fees, and millions of failures to deliver have created the perfect setup for another AMC short squeeze. And that's exactly what this article dives into. It says, since reporting its Q3 earnings, AMC has been on a bullish streak. It's also been helped by several broader market-related catalysts. Thanks to exceptionally high short interest in AMC, the stock's recent rally has pushed cost-to-borrow rates into the stratosphere, increasing the chance that short sellers get squeezed. During October, AMC shares failures to deliver breached 1 million on several trading days. And if we look at hedge funds positioning, something like the option activity, right? It's been very bullish. 70% plus of the open interest is held on the call side for the next couple weeks at the very minimum. And that is showing you something, because institutional investors, they are some of the largest positioners, obviously, in the markets. And when you see option activity like that, it tends to be a pretty telltale sign of kind of what's going on and how institutions feel towards a certain stock. Now, if you look at AMC on a technical basis as well, this is something that I have talked about very often, virtually every single video, is this 50-day moving average, because just looking at this, you can see how important the 50-day moving average is, because we gapped above it, and that was on November 14th, and every day since then, we have remained above the 50-day moving average. Not that we haven't tested it before. We tested it 1, 2, 3 days and bounced exactly at that 50-day moving average. Today is no exception. Even down 5.20% at the time of recording this video, you have still found a lot of support around the 50-day moving average. And until we break under that, we're still very much in a bullish uptrend. And the overall trend of AMC tends to be, if you break above the 50-day moving average and actually hold that level for multiple days, then you tend to go a lot higher than that over the subsequent following week. So as long as we hold above the 50-day moving average, which it looks like we are going to today, and we continue to hold above that until we get some bullish news or something to drive us higher, that's when the stock will go higher. As long as we stay above the 50-day, that is a very bullish thing. If we break under the 50-day and you are in some riskier trades, things like that, that might be a sign to get out and cut your losses. But from my perspective right here, it's looking incredibly bullish, and I would not want to be on the short side of this trade. Now, let's go ahead and dive into this a little bit deeper. This article, it says, taking a look at borrow fees. It says, borrow rates or borrow fees refer to the fees charged by brokerage firms when they lend stock to short sellers. The higher the rate, the more expensive it is to borrow a stock. Borrow fees are heavily influenced by the supply and demand conditions of the market. If a stock is in high demand for short sellers, borrow fees inch upward. Borrow fees will also increase as the supply of available shortable shares decreases. So there's really a lack of availability to get your hands on AMC shares to sell short. And the other side of that is it's riskier, right? There's a higher probability that AMC stock is probably going to go up from here. So people lending out their stock want a higher interest rate, because if you're lending out your stock and you don't have your shares, theoretically you couldn't sell your shares if the stock went up. If you expected the stock to go up 40%, for an example, wouldn't you want at least 40% in a cost to borrow rate? Yes. Well, that's what we're seeing right now. As of today, you are seeing about 70,000 shares available to be sold short, with a cost to borrow rate currently of about 44.33%. So that is extremely high. And that's pretty much what the cost to borrow average is sitting at. It's 44.73%. Cost to borrow minimum at 34.43%. And a cost to borrow max at 66.12%. So looking exceptionally bullish as far as the cost to borrow rates. And as you guys know, that tends to be one of the leading indicators if you're going to get a rally or not, tends to be the cost to borrow rates going higher. Now, as far as the other information that you probably want to know, 770 $788 million worth of AMC is still sold short. 20.14% is the short interest of free float. About 35% of the float is currently out on loan. Shares out on loan equals about 180.82 million. Days to cover 6.04. Cost to borrow trailing 3 months about 31% and still 100% share utilization. Now, one of the most exciting things I see right here is the days to cover at 6. That means it's very hard for shorts to get out of their short positions if they wanted to abruptly, right? If there was a reason for them to get out of their short positions, it would take 6 days to cover on all of those positions. And that gives you a lot of fuel to drive the stock up higher as well. Now, the last thing we're going to look at on the Ortex data is the open interest for the options. And like I said, out of the total options on November 25th, that is going to be this Friday, the open interest for the call side is sitting at 68.09%. The put side sitting at just under 32%. So almost a 2-to-1 ratio exactly, or a little bit more than a 2-to-1 ratio actually, of calls to puts, and that is definitely something that I like to look at on a daily basis, and you're seeing it getting more bullish and more bullish, especially the further out you go as well. If you look at something like January 2023, that is also looking exceptionally bullish. Now, let's go ahead and talk about what is happening here in the marketplace today, because it's a very weird dynamic that we have going on. Because on one hand, the S&P is down about 0.3%, the Nasdaq down over 1%, but you're actually seeing bond yields dropping today. So why is this happening, guys? Why are bond yields dropping? And that's not being a bullish factor to the markets, and the Nasdaq is still selling off 1%. Because as you know, when this chart goes down, stocks tend to go down as well. When this chart goes up or has a green day, stocks tend to go up as well. As basically yields fall, stocks become more attractive. Well, it's fears about a recession. It's fears about the FOMC minutes coming on Wednesday and what they are going to say about the terminal rate and where they're going to take federal funds rates. That's going to have a lot of implications of, do we go into a recession or not, or how bad could a recession be? Because right now the markets, they're only expecting 5 to 5.25% for the terminal rate. If we get a 6 or 7% high-end estimate for the terminal rates from the Fed, which is very possible we get on Wednesday, that's going to mean we are 100% going into a recession, like 100%. And even though we've seen a lot of pain in the stock market in 2022, we have not fully priced in what a recession would do to company earnings. And that is what you are seeing right now. I will say we could see a lot more downside if we get that 6 to 7% terminal rate, if the Fed gives us that on Wednesday. But at the same time, you're seeing the market starting to price in that recession into stocks, and that can get us closer to a bottom as well. So there's a little bit of good and bad. Over the medium term here, this is probably, I would say, a good thing if we can price in a recession. But over the very short term, it could be a super negative thing, guys. So that is really it. That's the biggest thing that is going on here in the markets that is really strange to a lot of people. If you guys follow that correlation between bond yields and the stock market, you can see the dollar is also up, which is no surprise. When the dollar goes up, the markets tend to go down, and the dollar is up almost 1%. So markets are down quite a bit. The bonds, though, that is the one that really makes you scratch your head and think that this move is all about a recession. Nonetheless, as far as economic data coming out tomorrow, you don't really have anything, but you have Fed Mester that speaks at noon tomorrow. You do have a 2-year bond auction at 12:30 that can move things around. A 7-year bond auction at 2 p.m. that can also move the markets pretty big. We have seen that as of recently. If the rates go higher or lower for these individual auctions, it can give the markets pretty big candles. So watch around that time to get yourself a big candle on the indexes. Now at 3:15 p.m. you have Fed George that speaks and Fed Bullard that speaks at 3:45 p.m. So depending on what these Fed speakers say, it could be big heading into Wednesday, where you will have durable goods orders month over month for October at 9:30 a.m. Initial jobless claims, continuing jobless claims, which that will also be important for the markets because we want the labor market to continue to soften. And then at 11 a.m. you have new home sales for October. And then the main catalyst, which is the FOMC minutes, coming at 2 p.m. on Wednesday, guys. So that's really what you guys need to know in a nutshell. Not too much else to actually say. AMC looking incredibly bullish as long as we can remain above that 50-day moving average, in which it looks like we are going to today, but that's where you want to watch the rest of this week. If we can get a bounce off this 50-day moving average, that could be very, very aggressive nonetheless, guys. So that is going to be it. Thank you guys for watching. Most importantly, enjoy the rest of your days, and I will see you in the next one.